Jim Farrell once thought that he'd have a long career as a farm broadcaster on the radio. He did not expect to become the president of Farmers National Company one day or a member of the Kansas City Federal Reserve Board, but he did both and more. Hi, I'm Dave Price, and this is the American Farmland Owner Podcast. Jim is mostly retired these days, but he still pays close attention to what the Fed is doing, how farmers are faring, and what the President of the United States is doing and saying. And those three tend to be pretty closely related. We will get to why Jim is not as concerned about interest rates as the president is. We'll do that in a bit. But first, how Jim makes sure that he is always up to date on farm and finance. Like any true farmer at heart, you apparently do not know how to fully retire, true?
Yeah, that's probably true, I would say. I retired from Farmers National Company and a week later took over Farrell Growth Group, a company my brother had started. And we sold it really a year ago. And so I'm still slightly involved in that, helping with a few things, but we, more or less that was taken over by Ocean Park Advisors. So we're out of that business now. I'm still involved in a couple of investment advisory boards. I try to stay busy.
So this keeps you connected in a lot of ways, finance, ag, and otherwise. And what are you consuming? What are you watching these days?
I read the ag press pretty closely. I read the Wall Street Journal for about an hour and a half every morning. I've done that for years. So those would be my primaries. Interact with people in the business that I know and have known for years, find out what they're seeing as far as what the market's doing and where we're at, that sort of thing. So it's a really interesting time. My history started back, with graduation from Iowa State in 1976. And right about the time I graduated, my dad was diagnosed with cancer. And so I had to make an abrupt change from the path I was headed on and went home and took over the family farm. And so my wife, we had just gotten married. She didn't want to marry a farmer. She didn't intend to marry a farmer. And of course, 2 months after we got married, we were farming. And it's just one of those things. But we farmed until 1986. So we farmed right through the farm depression, right through interest rates going from roughly 7% to highest interest rate I paid was 19.5 on operating and term loans. Went through that whole thing, and we were able to get out in '86. It was my dad, when he died, had a life use. Well, he gave life use to my mother, but he had an estate plan that was new at the time that required, or at least they interpreted it to require, that somebody from the immediate family farm the farm for 10 years in order to qualify. And a special use valuation is the type of farm operation it was. So we satisfied that and made a little money in 1985. Made enough in '85 that we could pay off our debts because we didn't have any land debt. And so decided to start over. So that was kind of my baptism by fire, if you will, into what the financial markets can do and what interest rates can do and what over leverage can do and, so on and so forth.
When you sell a family farm, I mean, that can be pretty gut-wrenching. How did you make the decision at the time? Were you torn, or did you know, looking at the numbers, this is what makes most sense? And I'm not trying to be a smart aleck, but maybe it made most sense for your family too, as your wife wasn't looking to get into that way of life.
Well, I had 2 kids at that point as well. We had a large hog operation for the time, and we were farming about 620 acres of ground in 1985 and coming into '86. But the good thing, Dave, there was no debt on the farm. My mom and dad owned 240 acres. There were 6 kids. I had 1/6 share of half of that because my mom had life use of the rest. I used that to leverage for operating capital, but that, and I paid off all my operating capital. So the family farm is still owned in the family today.
Hmm.
The home 160, although we sold the building site off, I sold the building site as soon as I quit farming to the young man who took it over at the time. And so that way, my mom, who became a landlord when I quit farming, didn't have to deal with the building site. And so that was not a challenge. There's an emotional challenge to quit farming. You have to decide, okay, are we making a good business decision, or did we just not make it in farming? Well, in 1985 and 1986, you didn't have to look very far for me to see people that had been in the business and that were my age now that were losing everything.
Hmm.
And it was pretty sobering, frankly. There were a few suicides. There were all kinds of things going on. It was a really ugly time. So we were fortunate to be able to get out, and I think we had, my wife and I have argued a little about this. We had either $500 left over or something less than that after
Hmm.
10 years of farming, but we didn't owe a dime to anybody. And so it was a way to start over.
Are we healthier now in that we are not as leveraged as we were back then? Is that a primary factor that should hopefully help us out through whatever rough patch we're in right now?
Well, that's a $1 million question.
Mm.
We've debated that a lot. I mean, farm debt, if you add in all farm debt in total, it's at record high, because it's not just banks today that are loaning money in farm credit. There's all kinds of other entities that are loaning money, including crop protection companies, just companies that are investing. They're coming in and helping farm operators out who maybe don't have as good a balance sheet that they can borrow from the bank. So there's a fair amount of debt out there. What we've been able to do is inflate it away through increasing farmland values. And the real wild card there, I suppose, if you wanted to look at it that way, was the amount of government program money that we started receiving in 2018 and 19 as direct payments in 20. That money in 2020 continued to influence things like the land market, which is 80–85% of a farmer's balance sheet typically. Started to even influence all the way through 2022 before that money eventually started to quiet down, and you weren't seeing it as much. So we've got really high land prices right now. And when you look at the return on investment, it's lower than it would have been, say, in 1983 or 1984, when the farm crisis was just getting started. So I don't know that I can give you a true answer on that. We definitely are not seeing balance sheets that look too far out of whack. And a lot of that has to do with farmland values that are at extreme high prices. But that has pushed cash rents up. In a Farmers National company, and when I joined the company in 1986, which is what I did when I quit farming, I went to Rochester, Minnesota, and took over, created a territory there at the time. Cash rent it was less than 10% of all the farms we managed at that time. And when I retired, it was 50%
Mhm.
of the farms, roughly. And as you go east of the Missouri River, it's nearly all cash rent. And so the financial risk in a cash rent farm is markedly different than what we saw in the 80s when mostly it was sharecrop. You know, so anyway, that's more than you wanted to know, perhaps. But so I
Not,
say it's hard to give you a straight answer
yeah.
and know that it's going to be accurate because it's just so markedly different than experience has taught me.
Well, so because of the additional federal support that you pointed out in 18 and 19, and then as we worked our way through COVID and beyond, it would at least feel like some of that may be lessened in the months ahead in this new administration. Do you agree? And if so, then does that also then kind of raise the stress level if that additional protection is not there?
I would say it definitely does. Yes, yes. When when 2013 hit and 14, we anticipated a retracement in land values, and we started to get that retracement. And it might have taken land values down to a little healthier value at that point. But what happened was that money came in and pushed those values and started pushing them back up again. So we didn't see the retracement we anticipated seeing at that point in time. It's not saying that we wanted to see a retracement. That's not always good in agriculture, but almost all markets go up and then they back up a little bit and then they go up again. And we haven't done that in agriculture to the degree that we really thought we would see after that massive run up from 2006 and 7. So as we fast forward to your question now, there will be stress, in my opinion, because of the fewer government program payments, unless the Trump administration, decides to do what they did last time, and that is push out significant amounts of direct payments. And I'm not sure if they will. I know that the Secretary of Agriculture has indicated that there will be payments, and I know there were some payments that were just made. That may slow down that impact of the negative prices that we have right now and the stress that we're seeing in the ag economy that I hear about and hear people talking about.
But as you know, that uncertainty is those payments to whom and how much.
Yes, yes, yeah. And then, well, there's one more uncertainty. I mean, if you look at President Trump's cabinet, he's got Kennedy in there, Mr. Kennedy. And
Hmm.
Mr. Kennedy, if you remember, was one of the architects of the Environmental Working Group, which was the group, if I recall my history correctly, and I think I'm correct on that, but they were the group that came out and reported all government program payments, pulled it off the website and started printing it and put a lot of pressure on government program payments. And he is not one who thinks government program payments are appropriate. So I don't know how that'll play out. I think it would be in the best interest of agriculture if payments were made in some respects. Some respects, it might be in the best interest of agriculture if things just cool down a little bit from the record pace of increases we've been seeing. Maybe a little bit of a cooling off period, maybe a little bit of a retracement in the market, let people regroup and start looking at, how this is going to move forward. And then you've got this whole trade war thing going on and how that's going to impact grain prices, which are already down from the peak. Uh, Very uncertain time.
Yeah, and is this short term, medium term, long term? We've had some folks here on the podcast join us about, it's hard to know because you're not inside the president's mind, and is he bluffing by going so big on some of these threats, and then the idea is you ratchet it down, we get a little give and take, we get something out of it, we're slightly, hopefully better off on the other side of it, or does this blow up and explode and we collapse? We're so good at growing stuff. We
Right.
have to have international partners or we're screwed.
Oh, I agree. I agree. What I hate to see, with the whole tariff thing that's going on right now is we become unreliable suppliers. And there's at least one field of study that would indicate, as we look back at the farm crisis of the 80s, that part of that crisis was driven in by the Carter grain embargo to Russia. And it had a great influence on South America and South America production because they took over our market. And we sat there and watched 1986. I remember selling corn out of the field in southern Minnesota because I didn't have storage for this corn for 98 cents a bushel. And we had, if I remember my history correctly, in 1986, we had 2 years corn crop on hand. in this country because of grain storage. Okay, so we haven't repeated that mistake.
Mm-hmm.
But when we become an unreliable supplier, there are other people that can step up and take our markets, at least in part, and that does has an impact. So I'm hopeful that cooler heads will prevail, and that your first analysis is what that is. We start big, we lower it down, we get a deal, we all feel good about it, and we move on. I hope that's the direction that we're going.
And as people have pointed out numerous times, another challenge here is that once someone finds a new supplier, it can oftentimes be difficult to get that customer back.
Oh yeah, yeah. I mean, you've become unreliable, so why would they come back?
You know,
You know, if you've got somebody that's providing a service to you, and suddenly they aren't doing a good job of it anymore, and you go hire someone else to provide that service, well, they come back to you and say, well, we've straightened it up, so now we can provide that service again. Are you going to jump ship? Well, chances are probably not if you're happy with the new service provider. So it's always been a challenge for ag. When we become unreliable, it costs us. And so I'm hoping that this turns into something shorter term and that we don't become unreliable. I mean, we don't want to become unreliable in the world, for that matter, in a variety of fronts. It would have impact on selling our federal debt, and what the cost of that federal debt is. And we carry a big debt in this country.
for sure.
And if other countries are not willing to buy that debt, or other investors, that has an impact as well. So all of it is kind of rolled together, and so all you can do is sit and watch it play out, and hope it plays out positively.
The president also seems to be fixated on interest rates. And as I was preparing to talk to you today, I was really looking forward to talking to you about interest rates because of your time with the Kansas City Fed. And so now that I already joked to you that you're not truly retired, but I know you still look at the numbers. And so what do you make about where interest rates are right now and this kind of nonstop pressure that the president has been putting on the Fed to lower the rates, which they have so far been resistant to do in light of all the other conditions out there?
Um, I think I'd start answering that question with a little bit of context back to 2009. I was 12 years on Fed boards, and I went on in January of '09 when the world was, seemingly falling apart.
Yeah.
So we took interest rates to zero at discount rate, the discount window, shortly after that, maybe even right at that point. I don't remember the exact timing. Um, so as you fast forward through my years on the Fed, I'd say most of my board members on the Kansas City Fed, and we were one of 12 banks, we felt that interest rates were too low and had been too low for too long. And I haven't changed my mind on that. I mean, the 0% interest, and then buying all of the securities and pushing all that money into the market. When I went on the board, I think we had maybe just under $1 trillion balance sheet. And I think at the peak, it was a $9 trillion balance sheet.
Mm.
And what that means is the difference between those two, that's how much money was pushed into the market. Okay, money that was created, money that was not there prior to 2009. That drove prices, including farmland and production costs. That drove all of it up. And we held it there, in my opinion, for too long. That's just my opinion. I mean, there's smarter people than me that were involved in making monetary policy, but looking at it from our corner of the world, and the 10th District Federal Reserve District that we operated in, interest rates stayed low too long. So you look at what happened in 2020 when inflation started, and 2021 and 2022 when we started to raise interest rates more rapidly after we took them to zero again,
Hmm.
and we left them at zero too long. Okay, and that started to create a lot of inflation. Uh, we we took them up high enough to slow inflation, which was a good thing, and now we've backed them off to where, in my opinion, we are not at a bad rate. I think where we are right now makes sense. Somewhere between 4 and 5%, even 3.5 and 4.5% on the discount window on those rates, to me, seems to be a reasonable place for us to be. President Trump is a real estate guy. Uh, I've never met a real estate guy yet that doesn't like low interest rates.
Yeah.
It's good for all the money you borrow, or if you're building commercial. And of course, he was a commercial real estate guy, not a house guy or
Hmm.
a farmland guy. And it takes tons of money to do commercial. And if you have to pay 4 or 5% versus 1 or 2%, that's a pretty significant difference. So, interest rates need to be somewhere where they provide a balance, and 0% was not it. And quantitative easing, in my opinion, went on too long. Uh, so we shoved all that money into the market, and we created higher valuations on stock than what traditionally would have been there. So stocks had been overvalued. It created all kinds of issues, and it also created a little disparity, I suppose you could say, in how the market operated. If you didn't have money as a you know citizen of the United States, if you didn't have money in the 401k or the stock market or somewhere like that, you didn't participate in
Hmm.
the go-go years of 2010 through 2019. Your salary didn't go up very fast, and you didn't gain. You actually probably went backwards. So, and that's a pretty good percentage of the country. Excuse me.
And I think some of those same factors you just pointed out here recently, and I follow uh, cover politics, and I think that was a big piece of the electorate for some folks, because you can have a misleading view of how things are going when you're looking at your 401k returns, right? And you're going, gosh, dang, a couple of years of this is awesome.
Oh
But
yeah.
if you're the one out of every two or whatever it is who don't really have money in there, and they're looking at their bills are going up faster than their paycheck, that's pretty simple math, right? I mean, they're going the
Oh
wrong
yeah.
way.
Yep. Yep. And so we exasperated that problem, I think, by trying to focus too much on trying to keep Wall Street healthy. So again, that's my opinion. And there's people that were have more experience and smarter than me that were involved in the development of monetary policy. But as we sat and looked at it at the board, and we interacted with Esther George, who was president for most of my tenure, although Tom Honig was president when I first went on the board. And I think a lot of both of them. They're both extremely sharp. They understand the Federal Reserve very, very well. And excuse me, they have a really good handle on monetary policy.
I
So,
wish I could take a remote control right now and rewind you about 5 minutes to play back for perspective here about the interest rate percentage you dealt with, you said, in the 1980s. For those who are younger, who are kind of freaked out about where things stand right now,
yeah.
because, for folks who've been around for a while, they know what this used to be like.
Oh,
And I
yeah.
remember my late father talking about this a long, long time ago. This is a big reason why, on the political side, my dad changed from a D to an R. Was the end of the Carter administration, what we were dealing with then, and then when Reagan came in. But for those who were around and lived through those, especially in adulthood, it gives you a whole different perspective, because you remember what you were paying on your house,
Oh,
on
yeah.
your land, whatever you borrowed on. So it's interesting to hear your perspective about maybe where we are right now is about where we need to be.
Yeah, it's in my opinion a very reasonable place for us to be. And as you referenced, I mean, my highest interest rate was 19.5%. I paid a
Hmm.
little more because I was a young farmer and I had no money,
Yeah.
and I didn't uh, I didn't get any money from the family to farm. So I mean, I borrowed all of the money. All of the money was borrowed, and it was all on floating interest rates. So it floated from 7% to that almost overnight. And then it went back down to something more reasonable, like 15 and a half. But when we bought our first house in Minnesota, when we moved to Minnesota in 1987, we intentionally locked in 10% interest rates
Hmm.
because we were not going to take any chances on interest rates going up. and 10% was a heck of a rate. So when you look at 5 or 4.5, thereabouts, that's really pretty reasonable. If we could see a 4% return on farmland or a 4.5% return on farmland, to me that's reasonable without appreciation, before appreciation. We're not looking at that right now. We're looking at something that's markedly lower than that right now, and it's not improving at the moment. With where the markets are. So, all of that has a balance or a relationship, in my opinion.
This this is a complicated question, but I'm going to try to throw it at you anyway.
All right.
In light of all these uncertainties we have, and I'm thinking, so I'm talking to you from Iowa, we've got corn and beans everywhere, right? So
Yeah.
now we have this complete uncertainty with international trade because we don't know how these tariffs are going to play out. And I've had some people talk to me about, in a perfect world, we would, and we need to support these people, but for those who maybe lack the confidence that they're going to do better in this trade war, or that they don't think this new administration is maybe going to push for renewables in some way that significantly grows demand for corn and beans, what have you, that maybe it's time to switch to something else.
hmm
That's pretty tough to do, though.
It is. Yeah. Yeah. You mean switch to a different crop?
Indeed.
Yeah.
And would
Yeah.
we
I
be
mean,
better served somehow if we rejigger our system to support that?
well, if you go back to even through my history, we were a lot more diverse when I was farming than we are today. Um, I had what was considered an above average sized farm operation in 1985, but I wasn't big,
Hmm.
but I was above average, and, but I also fed some cattle and I failed to finish about 1,000 hogs a year. And with that, I grew some oats that I would use for feed, but I also use that for pasture, or not pasture, but for spreading manure, if you will, and perhaps pasturing cattle on it, but typically just spreading manure. Today, we don't have quite that much diversity. I mean, you
Hmm.
raise hogs, oftentimes you're probably raising them today for someone else. And, not always. I mean, there are certainly entrepreneurs that are raising their own hogs, own chickens, and their own turkeys, but a lot of that has gone into contract. And so the diversification is simply corn and soybeans. And so, yeah, more diversification would be good. However, it's extremely hard to do it. Um, I I remember a situation. I think it might have been in Kansas where there was a group of farmers that decided they were going to grow sweet corn, and they built a sweet corn plant. And I think the whole thing ended up not going very well. If I remember right, it may have gone into bankruptcy because they were unable to get contracts to sell the sweet corn. So when I moved to Rochester, we had sweet corn on quite a percentage of our acres up there. We had peas, we had corn, soybeans, we had dairy cows, we had hay. You had all of that depending on where you were at and which county that I was operating in. And that diversity, did provide better cash flow when certain commodities went down in price. So people that were heavy into some of those commodities that were vegetables, they maybe didn't have as much stress as those who were strictly corn and soybeans. So um, it's a complicated question, like you
Hmm.
say. The big difference is you've got to have a market, and if you don't have a market before you plant, then it's maybe not going to work so well. And finding that market and then getting the distribution system is nigh on impossible in today's world. So it's a good idea, and I think it would make sense, but it's not something that I think we'll see. So,
So what do you, as we look ahead, we're talking in April, as you look ahead to the rest of the year, what are you watching?
well, I'm watching grain prices for sure, and I'm watching land values, and of course watching how this tariff thing plays out.
Hmm.
Do we indeed? I mean, one of the president's top advisors came out today and indicated that the big tariff that we put on China is in play. That's going to be lowered. Well, that probably would be a good thing, for us if it did get lowered down to something much more reasonable. So as that thing plays out, those are the things that I'm watching. Interest rates. I don't see them going up significantly. If anything, they'll probably come down a few points. I know Jerome Powell. I shouldn't say I know him well, but I was on the Fed board. I was chairman of the board when he was coming in as the head of the FOMC, chair of the FOMC. Had occasion to visit with him a few times, at different events. I have a great deal of faith in him. He's one who is not going to. He's not going to do something because it's politically correct. And the one thing that I think oftentimes people don't understand about the Federal Reserve in the United States is that the politically independent FOMC is such an advantage to the United States. And it's one reason why many other countries look at the United States as they think about their monetary policy. So I went to the international monetary policy that the Fed in Kansas City hosts every year at Jackson Hole in 2019. And there were central bankers from all over the world there. And if there was a common theme, it was that they were concerned with the push or the pressure that President Trump at that time was putting on Jerome Powell to lower interest rates, because that distance between politics and monetary policy is one of the greatest strengths that we've got going for us. The minute we turn that into some kind of a political football where politics are driving monetary policy, it will be a very big negative for the country, as you can see by what happened to the markets in the last 48 hours. And why President Trump came out today and said, I have no plans to fire Jerome Powell. So in which case I'm no scholar in that regards, but I know a lot about how the Fed operates and what the rules and regulations are. I don't think he could fire Jerome Powell. It would be a heck of a fight, and it would go all the way to the Supreme Court. And I'm not sure he'd win.
And would be unprecedented, and you do wonder the kind of pushback that he got from the business community about, hey, let's chill on this. And the markets are rattled for a bunch of different reasons. It's always interesting when he kind of reverses course and decides that he needs to say something publicly to get everybody to take a breath a little bit. And perhaps even his own people said, hey, this is probably not a fight either that you can win or that's worth doing.
Oh, yeah. It's not only a fight you probably aren't going to be able to win. It's going to be an ugly fight. And it's probably going to collapse a portion of the economy that's going to make things even worse. If the rest of the world loses faith in our Federal Reserve System and the way that we operate, it does play negatively on this country. And sometimes we think we stand alone, but in a lot of these things, we're part of a larger community, even though sometimes we don't want to be.
Indeed. Jim, we really appreciate the diverse discussion here, and I'm very appreciative you're not fully retired.
Yep. Well, it's it's a great thing being in agriculture. You can always continue on, even after you retire. So I've enjoyed visiting with you as well. So
thank you much. We appreciate it. Hope to do it again.
You bet. Thanks, Dave.
You can learn more about Jim's background in our profile piece about him. It's in the weekly American Farmland Owner newsletter. It's where landowners get their news from top industry thought leaders about the latest news, technology, trends, and challenges as they relate to farmland owners, investors, and the ag curious. Check it out at AmericanFarmlandOwner.com. Also, please like and share this podcast. It'll help others find us and join our conversation. Thanks for listening, and thanks for caring about the future of our farmland.